Turkish Airlines presents Business Africa.
Hello there and welcome to this brand new episode of Business Africa. I am Ronald Kato. This week, counting down to first oil, Uganda sees crude exports to start in October, but will oil be the windfall that will turn around the country's economy? No dollars, no problem. Zambia becomes the first African country to accept mining tax payments in the Chinese yuan. Plus, in no rush to sail, commercial shipping is reluctant to return to the Red Sea despite an end to Houthi attacks. The hesitation has meant more pain for the Suez Canal. Thank you for joining us. After decades with coffee and recently gold as its chief exports, Uganda is about to add another high-value commodity. The government says oil exports could begin as early as October, with revenues estimated at nearly $2 billion a year. Kampala is banking on oil to power its economy. But questions remain about the state's readiness to harness the resource for posterity, as Razia Athman reports.
Nearly 2 decades after oil was discovered in the Albertine region of western Uganda, production sites are nearing completion. At peak output, Uganda expects to produce close to 200,000 barrels a day, earning up to $6 billion per year. Officials say these oil revenues could help fund infrastructure, energy projects and public services.
The projects are having a significant impact on the country in terms of broader macroeconomic stability, where we have seen a significant percentage of up to 60 and 70% of the foreign direct investment coming into the country being oil-related.
But economists warn the impact may not be immediate, and with the general election underway, public spending is also under scrutiny. The Electoral Commission is spending $230 million on the exercise.
As Ugandans, we don't maximize the value we should get out of elections. If 21 million people don't show up to use those ballot papers that have already been printed with the taxpayers' money for them, who loses?
Oil has become a quiet undercurrent of the campaign, with the next president to oversee Uganda's entry into the global oil market. As voters head to the polls, Uganda is betting that oil will transform its economy.
Winfred Ngabire campaigns for accountability and compliance in oil, gas and mining sectors. Thank you very much, madam, for your time. How do you assess the capacity of the Ugandan state to effectively manage and harness this resource?
After 20 years of oil discovery and after giving our institutions 10 years of a head start, we should be prepared to harvest and harness the resources and keep the revenues for the purpose they were supposed to serve, depending on our national development priorities. So the preparedness on paper is there. How the institutions are well managed and, the capacities of these institutions to deliver is what I cannot confirm. But on paper, everything seems to be on track. So we should have no excuse as a country for not being prepared or being caught unaware. We have planned, we have invested, we have put systems, and our communities are expectant, the country is expectant, and we look forward to the money. We should be thinking of life with oil. What else can grow alongside oil production? Because we're not going to wait for the next 30 years, start thinking of then what. So can we develop the coffee sector, IT, AI? And as you know, the oil sector cannot even provide a lot of employment when we start production. It's highly technical, highly specialized. So we have a lot of unemployment, and we need to be developing those sectors that can absorb our young people, take advantage of the skills and the enthusiasm and the energy that the young people have, and it should have started long time ago.
Does the oil revenue management framework ensure that proceeds from oil sales actually benefit the country?
But we also have had instances where money has been picked from the petroleum fund without following due process. So are there concerns that this money could be abused? Absolutely. I think there are two things. There's having the institutions, the laws, everything in place, but the abuse by the political elite is still a very big threat. We know that it's likely to interfere with the oil revenues. We know that the parliament does not have the power to stop any abuse, at least as of now. So if we follow the national development plan, if we follow what the law says, if we follow what the systems say, we should be able to benefit. The political elite, they may need to cut their appetite.
Winnie, how does Uganda avoid the mistakes made by the likes of Chad, Angola, Congo, oil producers for a very long time, but remain poor and highly indebted?
So the last 15 years or so, our technocrats have been to all these countries to benchmarking from the countries that have the oil cash, benchmarking from countries that have done it better, like Norway. But we can only avoid the oil cash if we understand what an ordinary person wants and how to deliver them to that promised dream. If the money is not going back in form of royalties, in form of investments, then we are going to have only the capital that is developed, and we are going to have people languishing in poverty. There are frameworks that government has joined, including the EITI. Those frameworks provide opportunities for discussing oil revenues, particularly, and mining revenues. So if citizens can use those frameworks and understand how much money has been paid, that is going to save us a lot of problems and perhaps stop us from having the oil cash.
Winfred Ngabire, thank you for your time.
Thank you very much, Kato.
Zambia has become the first African nation to formally accept the Chinese yuan for payment of mining taxes and royalties. The decision was informed by a mix of trade and currency realities. China is Zambia's biggest source of imports and destination for its copper exports. There's also the need to reduce dependence on the dollar.
Africa's second largest copper producer is now accepting tax and royalty payments in Chinese yuan. Zambia's move breaks a decades-long tradition of African governments collecting mining taxes in US dollars or in their respective currencies. China is the destination of most of Zambia's copper. At the same time, Beijing is Lusaka's largest bilateral lender.
It's a move that is just not for operational pragmatism, but is more like a recalibration of currency. You're looking at risk, balance sheet management, and managing FX risk at the same time.
Zambia also maintains deep trade and investment links with China, particularly in mining, infrastructure development, and project financing. Currency diversification appears aimed at reducing exposure to episodic dollar liquidity shortages that have dogged the greater part of President Hakainde Hichilema's first term in office.
It also comes at a time when the central bank has these currency directives as well, trying to prop the currency and probably trying to reduce as much as possible dollar dependency, because part of the depreciation pressure that we've had as a nation has come from over-dependence on the dollar, for a lot of external payments and that pretty much would drive inflation.
And Zambia is not done leveraging its copper. The country has set a target to scale output from 1 million to 3 million metric tons by 2031.
Now, despite an end to Houthi attacks on commercial vessels in the Red Sea, many shipping companies are still keeping away. The pain is felt by Egypt's Suez Canal. Traffic through the strategic waterway remains roughly 60% below 2023 levels as container ships continue to reroute around the Cape of Good Hope on Africa's southern tip.
More than 3 months since the last attack on a vessel in the Red Sea, commercial shipping transiting the Suez Canal is yet to pick up. According to the shipowners' body BIMCO, traffic is still running about 60% lower than pre-crisis levels as the maritime industry wrestles with lingering security fears and economic uncertainty. It is, however, expected to pick up this year with the return of the Medex and Indemex services of French giant CMA CGM, which are due to start in mid-January. In December, the Maersk Seberok became Maersk's first container ship to transit the route in nearly 2 years. But the company's not committed to additional passengers, a sign that ship owners and insurers continue to view the Bab el-Mandeb Strait as a security risk. The attacks greatly disrupted transits through Egypt's Suez Canal, which links the Red Sea to the Mediterranean. The canal is one of the top sources of hard currency for Egypt, providing it with $10 billion in 2023 as the country's wider economy struggles. The International Monetary Fund says attacks by the Houthi reduced foreign exchange inflows from the Suez by $6 billion in 2024.
And that wraps up this episode of Business Africa. I am Ronald Kato. The news continues on air and online. Bye for now, and I'll see you on the next episode of Business Africa.
Business Africa was presented by Turkish Airlines.